All right, thank you guys for joining the Gateway Crossing Risk video. We're going to go over today with Chad Olsen here at Focus Capital as well. Talk about, what are the risks involved in this opportunity and really in real estate investing in general. And what we've outlined are three of the main risks that an investor could face with an opportunity like this. We'll go through things like the interest rate risk, the occupancy risk in the market, as well as what's the risk on the back end when we go to sell a property in 5 to 7 years. Chad Olsen, go and give a quick introduction on yourself here at Focus Capital.
Hi, my name's Chad. I'm VP of Investments here at Focus Capital. I handle the acquisitions, due diligence, debt placement, and then a little bit of the asset management, working alongside our asset manager, Chris Brown, on the properties. And this is our most recent investment that we got under contract just a few weeks ago and looking to close here in a couple months.
Awesome. Thanks, Chad. Well, investors, I feel like it'd be appropriate to go over the interest rate piece of this as well. We actually love Gateway Crossing for one big reason. That is because we are able to assume a debt at an interest rate of 3.53% fixed for the next 7 years. We feel like that presents a really good way to limit your downside risk on this deal in particular. I'm going to share my screen here real quick with you guys. While I'm doing that, Chad, why don't you just give some context on what we're seeing out there right now in the market with other interest rates on other deals?
Yeah. Yeah. So interest rates have obviously risen from the point that this was taken down. This was taken down in 21, 22 time period where they took out a loan on what we will call phase one. And there's phase one and phase two of the 160 units. Phase one consists of about 120 or so units, and then phase two consists of about 40. That'll become kind of more important as we get to the second part of this thing. But for the first one, they took it down to 21. Obviously, the rates were in a much different place than they are today, much lower. And they were able to lock in at that 3.53, as you mentioned. Spreads were down, base rate, 10-year was down. And we are now going to be able to assume that rate. Right now, we're seeing rates where, I think the next easiest one to compare to is Heritage Square. Heritage Square we just acquired back in May. We had rate locked that one in March, April time period. And we found the bottom in that moment, and we were able to lock in right around a 4.96, and that was after a rate buy down. Otherwise, rates should be sitting around 5% plus in the agency with no buy down. Of the recent quotes I've seen the last couple of weeks, mostly 5.5 to 5.8 is where I'm seeing for if they strike a lot of different boxes inside of Fannie and Freddie's loan boxes and criteria that they're looking for, mission driven, LTVs, things like that. So that's where we're seeing rates come in at. And so having a 3.53 that far below is extremely accretive and very attractive for us, especially with the basis that we're buying this at. And then, as I was mentioned, there's a phase one and a phase two. So, generally when you're looking at these assumable loans, part of the problem that comes into it, it's like, yeah, that's a great interest rate, but your LTVs might get reduced and you might be looking at taking something down 55 in the 50%, say. This one with the 60%, we're going to be over 60% just on the initial phase one, but we're also getting this ability with those other 40 units to take out a phase two loan or a new acquisition loan. And that loan, that rate will be more in that fives that I was quoting. But when you blend them together, we're going to end up in the low fours on a rate. And that's pretty stress tested because of the only being 40 units. The weighted average is really going to reduce that risk that we have on that other loan. So it's very hard unless things were to blow out the next couple of months to get anywhere over like a 4.5. And we should all feel really good about that. Hopefully we'll have the same kind of dynamic that we saw in Heritage's deal where we had these kind of valleys and troughs and everything else, peaks and valleys in the rates over the next couple of months. And we'll be able to get that locked in at a lower one, maybe be right at 4, but most likely 4.25, somewhere in there will be the range that we actually lock in at. And that's a really attractive rate in a time and place right now. It goes into the thing that we talk about a lot, and you were talking about kind of in the world of investing, which is people are walking into deals with negative leverage, not positive leverage. Our last deal was a case of positive leverage. This one is going to be much of the same. And having such an attractive rate at that low with the basis that we're acquiring it at the cap rate that we're acquiring it at will give us that positive leverage we're looking for, which is why it's such a strong cash flowing asset. But we get that protection with the 7 years that you were mentioning, where we're going to have 7 years on this term, on this loan, and at this interest rate that we can work and flex inside the business plan. And we'll pick up a little bit of interest only on the new loan, but obviously the original loan has since passed its interest only period.
Thanks, Chad. I think a couple of things that stood out to me there, really talking about the leverage piece of this, like positive leverage, and also looking at what's the runway in the next 7 years to where we aren't really going to be subject to rate inclines the next few years, like some people may be right now. So back to the whole positive leverage piece for newer investors that don't understand this, a quick clarification. So positive leverage simply means that the cap rate you're buying the deal at is lower, I'm sorry, is higher than the interest rate, meaning you've got a gap that you've got a spread to where you already have kind of built in a positive yield there on the deal. So it's a very good place to be in when your debt payment is less than what your cap rate is. And then, like I said, 7 more years here on this loan, plenty of runway here. And we've also factored in a refinance at the end of year 7. We had to refinance. It's going to be in a really good spot in 7 years, great cash flowing very, very well. So we feel like the interest rate risk that most deals normally face is not really a risk at all with Gateway Crossing.
Yeah, and
Uh,
I think that that point was really good. When we're looking at some of the value add deals that we typically look at, or most people looking, you're going to accrete that rate, that cap rate back up. So with your yield on cost, extract that value and bring it up over the debt. So you might take on a higher debt payment because of that risk, but it's all calculated into it. But that's additional risk, and you would expect a higher return. Well, we're still getting those returns that we would normally be looking at around that 15% with lower risk because we're coming in, positively leveraged. So it kind of goes to that thing about de-risking with this type of asset, along with that strong cash flow.
Yeah, it's so true, Chad. Like you have to, we look at deals that have a great risk-adjusted return profile, right? Ones that have a really a larger ratio of cash flow compared to the appreciation. So, because when you get more of your return from the cash flows along the way, it's lower risk to achieve the return on the final outcome there, which we'll get to that here in a minute, actually, with the exit scenarios with selling the asset. Let's dive into the occupancy part of this risk assessment. And occupancy really is okay, looking at the supply and demand story in the market. Is there too much supply? What's the demand for it? What's coming online? That could present some risk, as well as what are the other comparable properties in the area doing with the rents? Does that present risk? So let's pull up a slide here in a second that goes over some of the comps in the area, other comparable properties nearby, and it talks more about the job story. Chad, go over the job story if you don't mind first. Let's do that.
Yeah. So the jobs part of this, there's the River Ridge Commerce Center that's been under construction and in development for quite some time. And they were, when created and put this $1 billion investment into, the goal was to create 18,000 jobs. At this point today, they've delivered 12,000 jobs to that commerce center. So there's still an additional 6,000 to come. And it doesn't, from the news and other reporting that I've seen, it doesn't look like it's going to stop there either. They're going to continue to expand the commerce center and continue the investment because it's been so successful for the area. Part of that, coupled with just the changes post COVID, the logistics that Louisville has become with being a UPS hub, a FedEx hub, having 65 run through it, all those kind of things. Really strong dynamics for that side. We've seen a lot of investment into logistics, industrial, warehousing, all those kind of things on both the Louisville side and then especially on the Indiana side where there's plenty of land, cheaper tax environment that we've talked about a lot and all those other things. So we've seen that investment come and we've seen those jobs blow out. And that's why a good amount of supply was brought online the last handful of years, especially to the Indiana side. And we talked about this in our last deal. It's still a thing now. It's like we've seen a lot of supply, and that bottom chart I think is perfect and really indicative of it. Is you saw all the supply kind of come up and peak in 21, 22, and 23. And we had all these units get delivered far outside of the 10-year average, right? And that supply was delivered, it's been delivered, and now we're seeing construction starts kind of fall off a cliff, right? And that started in Q4 24, that's continued into 25. But all of that supply that might have gotten delayed, and we've heard this as a kind of a general talking point around the country. You've seen it in LA, or not LA, Austin, Phoenix, Nashville, down in Florida, a lot of supply get delivered, and then some of that glut had to hold on, and so it took another year plus for that stuff to come to market and then get through lease up and everything else. That's happened here. So some of these projects were delayed. They're now all in. So if you go to that same MMG that we cited there, they just came out with their Q2 construction report. There is nothing under construction now. everything is effectively in lease up or through lease up coming out of it. That's where it is. And then there's a few proposed sites from one developer in particular, but these sites, from what I'm being told, from what I've heard, and from what I've seen, are most the one of them might start putting a shovel in the ground in 26, maybe. Most of it sounds like it's going to be a 27 or later, and these are 200 to 300 unit projects that'll come up, within 2 to 4 years of each other over that thing, and that's healthy. Like, we should have a new 200 to 300 unit project get delivered every handful of years, right? In a market that's continuously growing and providing that new supply. And that was kind of the story before. For the last 20 years, there was no real investment into this area. That's a story around most of Indiana. We have a big glut of 60s, 70s, 80s builds, then nothing, a few in the 90s, a few in the 2000s, and then now we've kind of like started to come out of it as we've seen this growth in Indiana and Kentucky and the Midwest the last 10 or so years, right? So with that supply, like I said, everything's through under construction phase in lease up. There's really 2 or 3 deals that are truly in lease up on like the lower side of 50% or 50 to 70. They've been slower. There has been some deeper concessions, but again, we've reached that peak supply. We've reached those peak under constructions. And so we're seeing the last bit of it, the last noise, the last lash out as everybody tries to get people into their units or into their apartments, communities. And then next year we'll be really set up, and the rest of this year and next year we'll be really set up for the occupancy level to come back to where it was normally, right? So we were sitting, obviously the COVID peak 95, but really 93. It's come down to like 90, 91, and it'll probably come back up to 93% that we'll see across the market, especially in the A class, A and B class and stuff, and all the newer vintage stuff. And so, but that with that occupancy thing is part of the story of why we were able to acquire this for such the low basis and have the potential that we do, and getting it at the right timing. And then we see the future and where we're going to move towards with occupancies coming up, rent growth pushing beyond what it's shown in Louisville. In Louisville, we've seen 4% rent growth the last couple of years, if not more. Then we think that that's just kind of supercharged as more people continue to come to the Indiana side, more investment keeps going to the Indiana side, and the supply reaches a point and people don't want to develop anymore.
That's a great explanation, Chad. I think one point I took away just a minute ago from what you said was the rent growth of Louisville. And right now they're on track for 4% plus this year. Last couple of years, close to 4%. You know, do you, looking at our rent growth factor in our deal right now, I feel like it's pretty conservative, around 3.5% as an average. Is that what you have in here for Gateway Crossing?
Yeah, yeah, it's about that. With like that same kind of thing that we were looking at Heritage, where we think we get through peak supply, but we're a year beyond that, right? So we think that next year is really going to be the year that it's going to go, like, it's going to start and it's really going to ramp up. But we're projecting a year or two from then where we think that that peak rent growth factor, which is 4%, the most that we're going to do. And again, we're already 3 years deep into this, and we've seen that same factor remain. So it goes to the conservatism of it. It's like, yeah, we see rent growth. We're going to have rent growth in there. Why shouldn't we? And then, but we are putting some cushion in it to say, yeah, it's a couple years away. It's going to be a slow roll to that point. Here's what we're doing just in the market, using the market dynamics. And then, but it goes to the fact that, okay, well, with these dynamics, if we really believe in the supply and demand side, the growth side, we should see even stronger rent growth than that here in the years to come.
Yeah, that's a good point. I don't feel like we're banking on that future decline in starts, rent growth from that piece to fuel our business plan, but it'll be more of an upside for us, a cherry on top, so to speak.
Yep.
It'll be even greater benefit if it happens, but we're going to bank on that going into this.
Yeah.
Let's talk for a minute here about the comps in the area. We've got some really good comps here on this page to kind of talk to you about where Gateway Crossing is right now in relation to the other comparable properties and where it sits kind of in those different rent ranges, and as well as like what the runway is to climb those rents and increase them for the revenue of the property.
Yep. I think a lot of the charts along the bottom where you have your 1, 2, and 3 bedroom shows that we kind of sit in the middle of the market. The thing I'd like to highlight, like middle to bottom of the market, especially with the 1s and 2s. 2s are our heaviest weighted product. That's what we have the most of in our units. And then to focus in on the 3 bedrooms, we have the largest ones. they're townhomes more than they're anything else. We do not have any 3-bedroom apartments. So these are 2-story townhomes. They're very large, larger than anything else really in the market. And that's going to drive some of the rents on why, but we're still like lower than some of these other competitor products. So I think that's kind of a testament of where we could go with this and have a lot of room, especially on a price per foot basis. And then if you look along the comps at the top, it kind of goes to what I'm talking about. Some of these have moved quite a bit just in the last couple weeks. I think the slate is definitely well over 80%. Actually, it might even be higher. It might be closer to 90 from the broker I was just talking to. Arbor Place is closer to like 50. Laurel is definitely higher than that. I think in the 80s, if not more. The Bend, I know for sure, I was just told today, 85%. So occupancies are moving up in this market. And that's been accomplished through concessions for the last little bit, but they are moving up. And the trend line is still there and concessions are coming in. Everything's moving in the right direction as everybody kind of uses the spring and summer months to get occupied as the seasonality kind of works its way through.
So what I'm hearing there really is these newer products that were built in the last few years are now increasing occupancy up to 80, 90%. And we have the slowdown in starts happening and new jobs coming in. And I'm just seeing this as like a lot more demand for the current properties already existing there.
Yeah.
And that can only benefit our property going forward, I feel like, because as they have fewer and fewer vacancies in the market, they have to pick something.
Yep. Yeah, and they're going to move rents. A lot of these guys are going to have move rents quite a bit because it kind of goes to the basis conversation of what we're getting in at. Um, their basis on a lot of these other new properties is significantly higher, right?
So they
And
have to get higher rents to make
yeah,
it
and they
work.
have to get higher rents, and what they've been doing is kind of sacrificing some of that through either concessions or 1 month free. Well, that's all concessions, gift cards, some of these other things. They'll stop that completely, and then they'll start to get rents back into that pro forma line that they were expecting, or pushing beyond it, right? Which is what we all want to do. We all want to overachieve our business plans, and so that'll start to happen as the competition comes back between all that supply that's delivered over the last handful of years.
Okay, awesome. Thanks, Chad. Let's go over the third and final risk, which really is like, what's the exit risk on the opportunity? Like, what's the likelihood we can achieve that exit sales price in 5 to 7 years? What's the scenarios to where, let's say we miss it or we overachieve? How does that look? I think that's very important to look at because that's a big part of the business plan is what we're going to get to sale period in 5 to 7 years. But all along the same line, it's very important as well to look at what will the operations be the first 5 to 7 years with occupancy and debt playing a factor there. So let's go over that. I'll pull up the slide here that just shows really the analysis on sensitivity for these different cap rates. So Chad, why don't you give a little breakdown on, how we arrived at a 6 cap on exit estimate, how that matches up to other cap rates today and current properties being sold, and then lastly, what our exit price per door or per unit is, and how that lines up to what we're seeing today on trades.
Yeah. Yeah. So cap rate wise, most things, there was a deal under contract at the beginning of the year that was under a 5 cap. There was another deal that traded at the very early part of the year, obviously under contract before that. That was in the low 5 caps. And we're acquiring this thing closer to a 6, and our exit scenario is closer to a 6, right? So if everything was running and the market wasn't where it was, and the story that goes behind this deal wasn't where it was, should be trading between 5.25 to 5.5, if not less, right? And we're able to pick it up for that basis and then execute kind of the value that we want to do. So a 6 on exit feels really comfortable compared to what we're seeing today. We're still seeing several deals transact below 5, so we're right in that 5 to 5.25 range, and we're able to get this thing for a much better in place. And then there's those operational efficiencies that we cover in this deck in front of you, with other income, with the internet, with just moving the rents, with getting expenses, with getting rubs under control, all those different things that we're going to extract value out, that even makes that cap rate stronger, and that yield on cost that I mentioned kind of at the beginning of the call, that's going to get stronger and our spread's going to widen, and that's what we want. So a 6 cap in 5 to 7 years from now seems pretty strong. I mean, when I'm competing against other things, we are usually higher and more conservative in our cap rate assumptions. I'll get beat a lot from people that'll do 5.5 to 5.75 on exit right now. We don't feel as comfortable doing that in this environment. And we're willing to take what that comes with, and some deals we miss and stuff. But when we get good ones like this, that's where we feel far more comfortable about it. But as you kind of talked about, the big testament, the thing that we're most focused on is that basis conversation, right? So we're getting this at 140K a door. We're looking to exit this thing in that 5 to 7 year range at 185 to 190K a unit. And we have deals all over the place right now. You got deals in Zionsville selling for 220. You've got deals, 1990s deals on the west side that are out at market at 180 to $190,000. We have deals that have transacted at 160, $170,000 in tertiary markets around Indianapolis that are 1990s builds that have had no value add done to them. And that price per foot that we kind of talk about too is more along 180 to $200 a foot. This one, we're buying it way lower. We're going to be selling it about that $180 a foot and all that kind of stuff. So several years from now, that price feels very, very safe, and that anybody would want to take that down at that kind of a basis level. We just got to keep moving the operations there, which is part of the plan to get the cap rate and income to line up with it, which it will. And that goes to the buying it right every time, and we feel strong about that.
Yeah, thanks, Chad. I think as you're with that example there, I kept going back to the basis conversation. And when you buy a deal right and you buy it for a low basis, but well below replacement costs, that can really insulate us on, other downsides coming up here. It really helps protect our exit strategy here in year 5 to 7, where we aren't forced to sell at a really high price per door to make the whole business plan work because we already bought it at such a low price. We have plenty of runway here. I think it's also important to note too, like we at Focus Capital, we always leave 4 to 5 different layers to be conservative in our business plan to where, we think we can probably outperform here, but just to be conservative and just to give us some runway to outperform, we kind of give us some more cushion. That way, for you as an investor, we can hopefully overachieve for your returns. So that being said, thanks a lot, guys, for your time today. If you have questions at all for us, for me and Chad, reach out in the email here or through the link here in the video. Thanks so much.